After watching the previous money and banking videos, you should have a basic understanding of the definition and functions of money, as well as how banks can affect money supply through deposit creation and contraction. Now, let's look at the concepts of money market and money demand. In microeconomics, when we talked about demand and supply in a market, we've learned that the relationship between an item's price and volume of transaction can be demonstrated by a supply and demand graph. Similarly, we'll look at the relationship between nominal interest rate and quantity of money in a money market. Let's focus on money demand first. Demand for money, MD, can be separated into two parts, namely transaction demand for money, MT, and asset demand for money, MA. Transaction demand for money is the total amount of money that an economy wants to hold as a medium of exchange. We already know that money is a generally accepted medium of exchange which can solve various problems brought by barter trade. Therefore, one of the reasons that we'd have demand for money is money can help us to buy different goods and services. If we need more money for daily transactions, the transaction demand for money will increase. On the other hand, if there are some reasons causing less daily transactions, the transaction demand for money will drop as well. Transaction demand for money can be affected by many factors. First, our consumption expenditure and volume of transactions will increase with the level of national income. In this case, we'll need more money for transactions. The transaction demand for money will therefore increase with a higher level of national income. Second, when the general price level of an economy rises, it means that the price of goods and services is increasing in general. As we'll need more money to buy the things we want, the transaction demand for money will also rise. Third, if people tend to save less and consume more, then they'll need more cash for transactions. As a result, the transaction demand for money will increase. Fourth, the time interval between each time we receive our income also affects the transaction demand for money. Assume that our boss pays us $200 every day, and this $200 is enough for all expenses of the day. We won't need to hold any extra cash on top of this $200, as we'll get paid again the next day. But if our boss pays us $2,000 every 10 days, we'll need to hold more than $200 cash in hand. As we'll handle more transactions in 10 days compared to before, we'll need more cash. Therefore, we tend to keep more money with us in this case. From this illustration, we can see that the longer the time interval between every time we receive our income, the higher the transaction demand for money. Fifth, electronic payment methods like Octopus Card, Apple Pay, and credit cards are becoming more and more common nowadays. This created the trend of cashless transaction. If people choose to use these cashless payment methods, they only need to deposit their money into their bank accounts and can easily pay with their cards or mobile phones instead of cash. As a result, when electronic payment methods become more and more popular, the transaction demand for money will drop accordingly. One thing that we have to bear in mind is that the fluctuation of the market interest rate won't affect transaction demand for money. The reason is simple. Normally, we won't think about the market interest rate of the day while shopping or dining out. As the transaction demand for money is independent of interest rates, the curve of the transaction demand for money should be a vertical straight line on the diagram below. When the transaction demand for money increases, the whole curve will shift towards the right. When the transaction demand for money drops, the whole curve will shift towards the left instead. Another type of demand for money is called asset demand for money. It's the total amount of money an economy wants to keep as a store of wealth. In other words, if we want to keep more currency as asset, the asset demand for money will increase and the corresponding demand curve will shift towards the right. What will affect asset demand for money? Actually, it can be affected by the risk and return of assets in other forms, including deposits, stocks, bonds and real estate, etc. First of all, when nominal interest rates rise, we can earn more interest from our bank deposits. From the last session, we already learned that the cost of holding cash in hand will become higher in this situation. Therefore, the quantity of money demanded as asset will drop when the interest rate rises. We should pay attention that the nominal interest rate is the y-axis of the diagram. Therefore, a rise in the nominal interest rate will only cause a drop in the quantity of money demanded as asset instead of shifting the whole curve. So, we can see the curve of the asset demand for money is downward sloping. Second, usually there is some risk associated with return-generating assets like stocks. For instance, the stock price may fall suddenly. If the risk of holding these return-generating assets becomes higher, we will tend to hold fewer of them and switch to cash, which is nearly riskless. So when the risk of other assets increases, the asset demand for money will also increase. Third, the cost of asset trading will affect the asset demand for money as well. Cost of asset trading means the expenses such as handling fees involved in buying and selling the concerned assets. If the cost of asset trading increases, we'll buy fewer assets and hold more cash instead. Under such circumstances, the demand for money will rise as well. We've mentioned earlier that demand for money is the sum of transaction demand for money and asset demand for money. Therefore, by simply adding up the two curves of the transaction demand and asset demand for money horizontally, we'll be able to get a downward sloping money demand curve. In the coming videos, we'll put the money demand and money supply together and see how the equilibrium interest rate is determined in a money market. See you next time!